I'd like to start with what is happening in the world. We've seen a lot of choppiness in the crude market. Very crowded trade, which is the US tech stocks, they've got corrected. Dollar index also seems to be slipping. So, why do you think some of the crowded trades in the world are suddenly challenged?
Yeah, look, this really goes back to what happened in bond markets in September. So we had a big move up in bond yields in September. This sort of volatility shock went through risk assets, and that's still playing out with some heavily owned positions like tech. We've also had some very specific issues in tech. Apple has come out with guidance that has been disappointing around the iPhone. A very favorite tech name, NVIDIA, which produces graphic processing cards, it came out with very disappointing results, some guidance about excessive inventory. So I think you've got both the unwind of a crowded risk trade as well as some stock-specific issues hitting tech. And then if we think about the correction in another risk trade, which was being long energy and commodities, the energy price has come off very hard. It's come off hard because of fundamentals. One is inventory levels being high. The second is that the US has provided some sanction waivers that have allowed the major importers of Iranian crude to keep on importing for the near term. So I think you've got unwind of crowded risk trades, and two of those big risk trades had some fundamental factors that made them less attractive.
So, Adrian, do you think this entire change of policy stands by global central bankers that is in the price, or that is work in process and that will continue to add this extra dimension of volatility which has been missing for last couple of years?
Well, I'm not sure if I would say there's any real change in central bank policy. You know, the Fed has been on a normalization path for a period of time. Clearly, some of the statements by the Fed governors that happened in September probably did cause the bond market to wake up to the fact that we're on a normalization path. We're really seeing nothing, no change out of BOJ or out of ECB. So I think perhaps Powell's statements in September caused the bond market to move, and that big move did ripple through all risk assets. But I don't really see this as a policy change. I think it's steady as you go in terms of policy, but perhaps people's expectations around the Fed have been reacting to a strong US economy, a tight labor market.
Adrian, let's shift focus back to India. And, like Nikunj said in his opening comment, the silver lining for us is the fact that crude has cooled off quite significantly from where we were at about a month or so back. But having said that, the key that the markets would read into liquidity flows are coming back. We've already seen the kind of FPI flows month to date, and they're definitely net positive. Earnings have been at best just about in line. Do you see a meaningful earnings recovery coming in in this quarter, Q3, when we are going to take account and take stock of earnings? Do you think we'll have a starkly better Nifty performance?
No, I don't really see any drivers from earnings, but I do think, as you highlight, there's a very important macro driver here for India. So India is definitely the biggest beneficiary of a decline in oil price throughout the emerging market complex. So for what this means for India is it means a lower current account deficit, less pressure on the rupee, possibly less pressure on interest rates. And then as we look into 2019, the risk around rising inflation gets moderated by this. So I would view this as positive for India, but positive for India because it might allow a higher PE rather than helping the E at this point in time. If you look at the composition of the Indian market, particularly on the large cap side, you do have beneficiaries of a weaker currency. And so ironically, they may be less benefiting from this move in oil. So I think it's perhaps also a good signal for a change in the sector movements within India. For this year, the smart thing to have done was to be very overweight exporters. I think you need to start reducing your exporter exposure and start to think about some more domestic cyclical names that might benefit from an easier macro environment in 2019.
Sitting out of Hong Kong, Adrian, how are you viewing the deal that's brewing as far as Jet Airways go? The beleaguered airline carrier is seeing a fair amount of speculative trading over the course of the last 10 days in anticipation of what may come by from the Tata Group. And I'm not asking you to comment on the stock, but really how you're seeing the opportunity, because it may be a path-breaking deal if it does happen for the aviation sector, with the Tata Group taking over Jet and merging it with some of its current businesses.
Yes, so I would view this as broadly positive. If the Tata Group can acquire Jet Airways, and really what you're thinking about acquiring is predominantly things like landing rights, etc. Obviously, a crew and an aircraft. And if India's got a large group with the financial capability to do this, with a history in airlines. I mean, Indian Airlines was originally set up by the Tata Group. I think that would be viewed as a positive. For me as a strategist, it's always very difficult to have a strong stock-specific view, particularly on M&A type situations, bankruptcy type situations, which tends to lend to the skill of an analyst as opposed to a strategist.